Okay, let's unpack this. Today, we're doing a really granular dive into extra space storage, ticker EXR. And for a critical investor like you, this one is essential because EXR isn't just another REIT. It is now the undisputed largest self-storage empire in the U.S.
Right, especially after that massive all-stock merger with Life Storage LSI back in 2023. That was a $12.7 billion deal. It changed the landscape.
And our mission today is really targeted. We're going way beyond just, a summary of their last quarter.
Exactly. We have to dissect the core tension here. I mean, this is a company with a formidable empire. We're talking over 3,700 locations, 280 million square feet. So the real structural question is this incredible operational machine facing maybe a permanent impairment? Or is this just a cyclical storm that's creating a great buying opportunity?
Exactly. You, our listener, you're sophisticated. You get cap rates. You get FFO growth. So you see the paradox immediately. You have this, perfect operational machine that is battling a fundamentally hostile macro environment. We need to cut through all the noise here, the management talk, the market panic, to figure out if value generation is really broken or if this is just a timing problem.
And that timing issue is the central framework for this whole deep dive. We're calling it the bifurcated cycle. On one side, you've got EXR's internal machine, their operational excellence, that data moat they have, the synergies from LSI. Everything's pointing up there. But on the other side, you have these huge external headwinds. The housing market is frozen solid. Property taxes are crushing them. They're still oversupplying key markets.
Because the question that defines the next 2 years of returns is just that timing.
When does that external pain ease up enough for the internal machine to start generating real growth again? And, is the stock priced for that? Wait until maybe 2026.
Well, let's start with the good stuff. Before we get into why the machine is struggling, we need to remember why anyone even cares about self-storage to begin with. The unit economics have been historically just incredible.
It's really enviable.
So, industry dynamics, the high-margin business under macro siege.
Right. So when you compare self-storage to almost any other type of real estate, office, retail, even multifamily, the profitability difference is just stark. A good, stable self-storage facility runs with gross margins somewhere between, say, 65 and 75%.
And that is the magic number. I mean, a trophy office building would kill for a 40% NOI margin after you account for all the tenant improvements and commissions.
And not even close. And the reason for that margin is the lack of friction, the low capital intensity of the business.
Right. Think about an office space. A tenant leaves, and you're immediately spending a ton of money on commissions, build-outs, maintenance. What do you do when a storage unit tenant leaves?
You get a broom. You sweep it out, maybe a new coat of paint every few years, but that's pennies per square foot. And this leads us to the holy grail for a REIT investor, which is really low maintenance capital expenditure. We're talking routinely below 5% of gross revenue. Sometimes it's as low as 3%.
And that low capex, that's the bedrock for the whole dividend, isn't it?
It is. That lack of friction gives you this amazing conversion rate from funds from operations, FO, to adjusted funds from operations, or AFO. That high AFO conversion is what makes the dividend so resilient, even when the economy gets rough and other REITs have to start cutting their payouts.
It's just the lean cost structure.
Incredibly lean. I mean, besides the two big things we'll get into, property taxes and insurance, the expenses are pretty minimal. You've got personnel, maybe 1 or 2 people per store. Sometimes it's all remote now. Then utilities and marketing.
It's nothing compared to running a shopping mall or a high-rise apartment building.
No. The operational drag is minimal. That's why EXR can consistently hit NOI margins in the low 70s. It's a cash flow machine.
So it sounds like a perfect business. High margins, low capex, sticky customers. Which begs the question, why did we just see flat or even slightly negative revenue growth?
And that brings us to the frozen engine. This is where the historical resilience story kind of breaks down.
We always hear about the 4 Ds of storage demand.
Death, divorce, dislocation, and downsizing. The argument was always that a couple of those are basically recession-proof. But the post-pandemic world has exposed this huge vulnerability, which is that the sector is just overwhelmingly tied to housing turnover, specifically dislocation.
And anyone tracking the macro data knows that housing turnover is at, multi-decade lows?
It's fallen off a cliff, and it's all because of one thing: Mortgage rates.
The lock-in effect.
The catastrophic lock-in effect. If you refinanced at 3%, you are not moving when rates are at 7%. You're just stuck. And historically, that dislocation, driver, people buying, selling, moving, that was 40 to 50% of all storage demand.
So the top of their demand funnel just completely dried up.
It's gone. Which means they're fighting for a smaller pool of customers. They're basically forced to rely on their existing tenants staying longer.
Which we'll get to with ECRI. So what's the immediate effect of this?
Street rates collapse. New customers are really scarce and they're very price sensitive. So to get people in the door, EXR has to offer these deep discounts just to attract the few people who are actually moving. That's where you see the pressure on revenue.
Okay, let's zoom out to supply, because this is where the whole long-term bull case for EXR really rests.
Right. So the current pain is definitely from digesting this huge supply surge from roughly 2018 to 2024. A lot of developers, especially in the Sun Belt, think Atlanta, Phoenix, Vegas, they built aggressively into that pandemic demand.
And now we're in the hangover phase, the oversupply.
We are. And that's what's killing street rates in those specific markets. That's the pain you see in the numbers right now.
But the forward-looking part, the reason to maybe hold through this, is that the future pipeline is shrinking fast.
It's the most compelling part of the story. High construction costs, lumber, concrete, labor plus high interest rates have just caused new development starts to plummet.
Yeah.
The banks have turned off the spigot.
Can we actually quantify that? How much has it shrunk?
We can. The current under construction pipeline is now down to about 2.6% of existing inventory. At the peak, back in 2019, that number was often well over 6% in some of these markets. It's a huge decline.
So if it takes, 18 to 24 months for a new facility to come online?
Then that drying pipeline means a supply cliff is pretty much inevitable.
Right. So the pain we're feeling in 24 and 25 is basically setting up the next cycle of pricing power for them in 2026 or 2027.
Exactly. For a critical investor, holding on is a bet on the inevitability of that supply cliff, because the barriers to entry right now are higher than they've been in a very long time.
Okay, so the business is great, but the macro is terrible, and that sets up a potential 2026 recovery. Now we have to talk about the moat. What justifies EXR's premium valuation? How durable is this advantage?
Well, it all boils down to scale and, more specifically, data supremacy. And that's all centralized in their management plus third-party platform.
This isn't just a side business for them.
Not at all. It's the core of their informational edge. EXR manages over 1,800 third-party stores. That's on top of the 2,000 or so that they own. So you have this network of over 3,700 locations constantly feeding them data.
That's the network effect. It's not just about the units they own, it's the sheer volume of data they process from all these micro markets every single day.
And that data supremacy is their real, unreplicable moat. They see real-time transaction data from over 4,000 stores daily, occupancy shifts, move-ins, pricing elasticity.
So a small mom-and-pop operator is just flying blind compared to them.
Completely blind. They might update their prices once a month, manually. EXR is doing it algorithmically, daily, sometimes hourly, unit by unit. That precision lets them squeeze out every last dollar of rent without pushing people out.
What's really fascinating, and I think a lot of people miss this, is the cost absorption benefit.
Yes.
Those third-party owners aren't just giving them data, they are literally subsidizing EXR's corporate overhead and tech budget.
That is absolutely critical to their margins. The management fees from those 1,800 stores pay for a huge chunk of their G&A and R&D. So if a competitor wanted to build a similar pricing engine, they'd have to fund that all themselves. Their margins would get crushed. It's a brilliant self-funding, self-reinforcing cycle.
And it creates this incredible proprietary acquisition pipeline, the first call advantage.
Exactly. When one of those third-party owners decides to sell, who do you think is the first call?
EXR. They already know the asset inside and out.
Perfectly. They know its history, its customers, its true potential. This lets them bypass the whole competitive bidding process that inflates prices, and it dramatically reduces their diligence risk. It's a huge advantage.
So let's talk about how they're using that data right now to fight this zero growth environment. This is the ECII game.
Existing customer rate increases. This is the strategy that is keeping their revenue from completely collapsing. The game is you offer these low teaser rates on the front end to get people in the door. We saw street rates down 10, 12% in some markets. The goal is just to maximize occupancy, keep the machine full.
And they did. They were at 93.7% occupancy in Q3, so they fill it up cheap.
And then the payoff comes from aggressive, algorithmically timed rate increases on those existing customers.
They're exploiting customer inertia, the hassle cost.
The hassle cost. It's the highest barrier to exit. Once your stuff is in that 10 by 10 unit, the pain and expense of renting a truck and moving it all to save $20 a month is just, it's huge.
So the critical question for an investor is, how sustainable is that? Are they pushing customers to a breaking point?
That's the tightrope they're walking. They use their data to test that elasticity. They know a 5% hike on an 18-month tenant is fine, but a 15% hike on a 6-month tenant is risky.
And what's the data telling us right now? Is churn ticking up?
For now, churn is stable. It suggests the strategy is working, and customers are, for the most part, swallowing the hikes. But the risk is that if this continues, you start to erode that long-term customer trust. You turn a reliable customer into one who's just waiting for a chance to leave.
Let's talk about the industry structure. Over 60% is still mom and pop, but in the big cities, the major markets, it's basically an oligopoly, right?
It is. EXR, Public Storage, CubeSmart, they control the key MSAs, and that's key to their margins. The physical barrier to entry building a new shed is pretty low, but the operational barriers are incredibly high.
Because a small operator can't afford the tech platform.
Exactly. They can't afford the pricing engine, the data integration, or the incredibly efficient digital ad spending that EXR has perfected.
So EXR can run at a 70% OI margin, while the local guy down the street is struggling to hit 55%.
That 15-point difference is the digital moat. EXR's ability to dominate Google search results is a huge part of that. They get customers for a much lower cost.
But every moat has a threat. What's the thing that could really disrupt this digital advantage?
The big, unpredictable threat is Google itself. If Google changes its algorithm to favor hyperlocal results over big national brands, EXR's marketing machine could break overnight. The other, maybe more futuristic threat is the rise of AI agents for consumers. Imagine an AI that could shop for the best storage rate and negotiate on your behalf. That would kill the advantage EXR has over individual, price-insensitive customers.
Okay, so we've established the strengths. Now we have to get into the friction, the red flags. Because for an investor focused on execution, the recent numbers are, well, they're alarming.
Yeah, let's put this in context. EXR was a legendary compounder. For the 10 years ending in 2021, it was the top-performing REIT out there, compounding at over 22% a year.
An incredibly high bar.
And the current reality is a complete painful stop. The Q3 2025 numbers confirm it. Same-store revenue growth was actually negative 0.2%. Core FFO per share grew by 0.5%.
Basically zero. The organic engine has just stalled.
And that negative revenue growth tells you the mark-to-market on their rent roll is negative. New customers are paying less than the customers who are leaving.
So they're filling the bucket with cheaper water than what's leaking out.
Exactly. And they're relying almost entirely on those ECRIs to keep the total revenue line flat. But the biggest near-term threat isn't even the flat revenue. It's the costs. It's the negative leverage.
Walk me through that. How does that negative leverage work?
This is the operational squeeze. Same-store expenses in Q3 rose 5.8%. So when you have expenses rising almost 6% and revenue falling slightly, you get severe margin compression.
Because the costs are fixed.
Largely, yes. So for every dollar of revenue you fail to gain, your operating income falls by more than $1 because those underlying costs are just rising relentlessly.
And what's driving that massive 5.8% increase? It's not staffing, is it?
No, it's overwhelmingly two things they can't control: property tax shock and insurance costs. Property taxes are the main culprit, especially in states like Florida and Texas where they have a lot of exposure.
Let's go granular on that because that feels like a sticky headwind.
It's very sticky. It's a lag effect. Property assessments trail the market by a year or two, so the huge run-up in real estate values from 2021 is only now hitting the tax rolls. Municipalities need money, so they are aggressively reassessing these properties, and EXR's tax basis has just skyrocketed.
And that flows right to the bottom line. It's the reason their net operating income, their NOI, fell 2.5%.
It eats directly into their cash flow.
Yeah.
If revenue is flat and property taxes are rising 8% a year, that high-margin business degrades really, really fast.
Okay, now let's talk about something that's often overlooked, which is their bridge loan book. This is EXR basically acting like a bank.
It's become a critical lifeline for FFO growth. The portfolio is over $1.4 billion. These are high-yield loans to developers, and the interest income they generate is helping to plug the hole left by the weak property NOI. Without this, their earnings would be deeply negative.
And strategically, it's part of their loan-to-own pipeline.
Right. But it introduces serious and kind of hidden credit risk. And we got a stark reminder of that in Q3. They had to transfer a $26.9 million loan to non-accrual status.
That's a big deal. What was the collateral on that loan?
And this is the key part. It was an apartment building, not a self-storage facility.
So they're lending outside their core area of expertise.
It looks like it. It shows a higher risk appetite to chase that yield. And it's a huge warning sign that if the commercial real estate market gets worse, EXR is exposed to more write-downs and the headache of owning assets they don't even want.
All right, let's pivot to management discipline and capital allocation. For a critical investor, this is the ultimate test. And this brings us to what might be the most concerning metric we've seen: return on invested capital.
Yeah, what's fascinating here and what really challenges the valuation is this idea of economic value creation. Historically, EXR was great at this. ROIC was in the 8 to 10% range, well above their cost of capital.
But now, after the big LSI deal, that metric has compressed. Seriously compressed.
It's a massive red flag. Our estimate for their ROIC now is hovering around 4.9%. And you have to compare that to their weighted average cost of capital, their WACC. Conservatively, their WACC is in the 6 to 7% range. Realistically, maybe even higher right now.
Okay, break that down. Why is a 4.9% ROIC so bad if their WACC is, say, 7%?
Because it means they're actively destroying economic value. The capital they're deploying, mostly through that LSI acquisition, is generating a lower return than the cost of that capital. I mean, think about it. Their cost of equity is probably 9 or 10% in this environment. So when you blend it all together, their cost of capital is clearly higher than the return they're getting on new investments.
And it seems like management knows this.
Their actions say they do. The fact that they completely halted external acquisitions in Q3 is a huge signal. They've admitted that at current prices, buying more stuff is dilutive. It destroys value.
Let's talk about the centerpiece of that strategy, the Life Storage mergers. $12.7 billion, all stock. It was a massive bet on scale.
A bet to create a duopoly with Public Storage. It was strategically necessary, but financially it was really aggressive.
Using all stock was smart. It protected the balance sheet.
It did. It saved their BBB plus credit rating. But it massively diluted shareholders, and it made the math for growth incredibly tight. The whole thesis now rests on synergies.
They targeted $100 million in synergies. How are they doing on that?
The early signs are pretty good, actually. The integration was incredibly fast. And the plan is to move all the old LSI stores onto EXR's superior tech platform. LSI always had lower margins than EXR. So by applying their pricing algorithms and ECRI strategy to that LSI tenant base, they're successfully closing the performance gap. Those synergies are the only thing offsetting the zero organic growth right now.
Okay, turning to the balance sheet, how safe are they in this high-rate world?
Their leverage is okay. Net debt to EBITDA is around 5.2 times. It's a little higher than PSA, but it's fine for their rating. But what's crucial, what makes them a safe harbor in the REIT space, is their debt structure.
The fixed-rate debt.
It's their ultimate insurance policy. Roughly 89% of their debt is fixed rate. This completely insulates them from the immediate pain of rising rates. They've pushed out their debt maturities. They're safe.
All right, let's look at the signals management is sending. The dividend yields around 5%, but the payout ratio is getting a little tight.
It is. It's running between 78 and 80% of core FFO. That's sustainable, but it tells you that maintaining the dividend is the #1 priority. It leaves very little cash left over for anything else.
And what about share buybacks? The stock has pulled back a lot, but they haven't really been buying.
And that is a really subtle but important signal you have to pay attention to. Their lack of buybacks tells you that management does not think their stock at 16.5 times FFO is a screaming bargain. If they did, they'd be buying aggressively. Instead, they're putting that capital into their high-yield loan book.
And what about insider activity? Any signals there?
It's a pattern of net selling, actually. The CEO, Joe Margolis, sold stock in October and in July. Now, some of that might be pre-scheduled, but the complete lack of any significant insider buying at these lower prices is telling. Management isn't putting their own money to work here, which suggests they're pretty comfortable with the current valuation.
All right, time for the judgment. We have a best-in-class company, a great moat, but a terrible environment with rising costs and falling ROIC. What does the valuation tell us?
Well, EXR is trading at about 16.5 times forward FFO. That's a slight premium to the broader REIT sector, but it's a big discount to where EXR has historically traded during its high growth days.
So it's not crazy expensive, but it's not cheap either, given the zero growth. This is where that spread problem becomes really important.
It's paramount. The 5% dividend yield is just not that much higher than the risk-free rate you can get from a 10-year Treasury note. That spread is historically thin. It means you are not getting paid very much to take on all the risks we've talked about, the property tax shock, the credit risk, unless you're really confident that FFO growth is about to come roaring back.
So if you run a DCF on this, what kind of growth is baked into the current price?
To justify today's price, you have to assume that growth gets back to that historical 4 to 5% range by 2027. If, however, growth stays stuck down here at 0 to 2%, then the stock is probably 15 to 20% overvalued. It all hangs on whether you think this is a short-term rut or a long-term saturation.
Okay, let's run through the three key scenarios for an investor. Let's start with the bull case.
The bull case, where the stock goes to 160 or higher, needs a macro thaw. Mortgage rates have to fall, unfreezing the housing market. LSI synergies have to beat expectations. And most importantly, that 2026 supply cliff has to hit hard, giving them pricing power again. In that world, the multiple re-rates back towards 20 times FFO.
And the bear case, the one that takes it to 110 or lower.
That's the higher for longer world. The housing market stays frozen, property taxes keep rising 5 to 8% a year, and FFO actually starts to contract. Then the dividend gets tight, and the stock is forced to re-rate down to a 12 or 13 times multiple, like a boring, low-growth utility.
And the base case, which feels like where we are now.
That's the muddling through scenario. Flat organic growth is offset by the LSI synergies, giving you maybe 1 to 3% FFO growth. The dividend is safe, but there's no real capital appreciation. The stock just acts like a bond.
So synthesizing all of this, what's the final verdict?
I think it lands squarely at neutral, maybe a cautious hold. EXR is the definition of a bad environment, good house. They are the best operator in the space with the fantastic data moat. But the sector itself is just fundamentally stuck because of things management can't control.
So the key takeaway is that buying today isn't a bet on 2025 fundamentals. It's a high conviction bet on a 2026 macro recovery.
Precisely. And that recent Q3 miss is a warning that the bottom might be, draggier and deeper than people think. You are buying optionality on a future rate cut.
But there is one little green shoot we have to mention at the end here.
Yes. There's a very recent data point from October that showed street rates for new customers just turned positive for the first time in months, up 3 to 5%. That's the number to watch. If that trend continues, it signals a definitive bottom in the pricing cycle and makes that 2026 outlook much stronger.
Fascinating. So the data moat is holding, but the environment is toxic. The investor is basically just buying a calendar date.
So what does this all mean, big picture? The core tension is still there. EXR's operational machine is firing on all cylinders. They're using their data, they're getting the synergies. But that one big macro variable housing turnover is completely out of their hands. The whole investment thesis hangs on a macro thaw that looks like it's timed for 2026.
And since we focus so much on expenses, I think there's one final structural question we have to leave you with, something that could undermine the whole business model long term.
We talked about how the hassle cost is their moat. It's what lets them push those aggressive rate hikes. But the question for the next 5 years is this. If they keep pushing 8 to 10% rate hikes every year and property taxes keep rising, at what point does the consumer just say enough? At what tipping point do people start looking for permanent, non-REIT storage solutions instead of this volatile monthly lease model that EXR exploits?
You mean things like portable storage systems, like pods, or other models that don't have the huge building costs and, crucially, don't have the local property tax burden.
Exactly. Is their digital moat strong enough to fight a war on two fronts? The expense shock from governments and a new, more flexible competitor that sidesteps the whole real estate game. That is the ultimate strategic risk to the long-term thesis. Something for you to mull over until the next deep dive.